Welcome back to the Deep Dive. Our mission, as always, is to give you that shortcut to being well-informed, really cutting through the noise on complex topics. Today, we're doing a deep dive into Bitmine Immersion Technologies. That's ticker BMNR. It's a stock that's, well, it's become a real lightning rod in the crypto space. We went through a huge amount of research on this one, and honestly, what we found is this pretty incredible story of financial engineering, a really wild strategic pivot. And when we boiled down the valuation, the numbers were actually quite clear. BMNR seems to be trading at a significant, like a quantifiable discount to its assets. Basically, the stock price implies you can buy $1 worth of their underlying Ethereum in cash for about 86 cents.
Yeah, and that 13.9% discount isn't just, an interesting data point. It's really the heart of the dilemma for anyone looking at this stock. It forces you to ask, is that gap, that nearly 14%, a genuine margin of safety, a clear arbitrage opportunity you should grab? Or is it just the price you have to pay to even step foot into what might be an investment minefield? That's what we need to figure out today. We're going to unpack BMNR's big shift, look at the clever financial engine keeping it going, and really decide if the, frankly, extreme risks outweigh this apparent value gap.
Okay, let's jump right in. We need to understand what this company actually does, or maybe what it used to do. Chapter 1, Business Analysis. From miner to digital treasury. So BMNR started out in Bitcoin mining, focusing on the infrastructure side. Their original claim to fame, technologically speaking, was immersion cooling.
Right.
Which is this pretty advanced technique where they literally submerge the mining computers in a special non-conductive fluid. Sounds a bit sci-fi, doesn't it?
It does, but the results, at least according to the reports, are pretty impressive. We're talking significant efficiency gains. Immersion cooling is said to boost the hash rate, that's the raw computing tower, by something like 25% to 30%.
Okay.
But maybe more importantly, it's about efficiency and lifespan. It apparently cuts electricity use by up to 40%, which is huge in mining, and helps the hardware last longer because it's kept cool and protected.
And this isn't some niche market either, right?
Yeah.
The whole immersion cooling sector is expected to grow pretty fast. Forecasts put the growth rate, the CAGR, somewhere between, 24% and 36% over the next several years?
Exactly, a solid underlying tech market. But, and this is the crucial point, that's not what's driving the BMNR story today. The real narrative kicked off in mid-2025. They called it the Great Pivot, the alchemy of 5%. Basically, they shifted gears completely, moving away from mining ops toward aggressive Ethereum accumulation. This was spearheaded by their new chairman, Tom Lee.
And aggressive is almost an understatement here. Their stated goal is, frankly, enormous, to acquire 5% of all circulating Ethereum. That's effectively trying to corner a major piece of one of the world's biggest digital assets. It's incredibly ambitious.
And they're moving fast. The data we saw from late September 2025 showed they already held over 2.4 million ETH.
Wow.
Which is already more than 2% of the total supply. That instantly made them the biggest corporate holder of ETH anywhere. And for context, the second largest public corporate crypto treasury overall. Only Strategy Inc., MSTR, holds more in crypto value, but that's all Bitcoin.
So the competitive edge now isn't the cooling tech anymore. It's the sheer scale and this laser focus on accumulating ETH, which, as you said, basically turns BMNR stock into a liquid, publicly traded way to get exposure to Ethereum.
Precisely. And that's incredibly valuable for certain investors, especially institutions that maybe can't or won't hold digital assets directly due to regulations or their own mandates.
Okay, so if the strategy shifted so dramatically, we need to look at who's calling the shots.
Absolutely. That leads us directly into understanding the management team and their approach.
Chapter 2. Management evaluation, the cult of personality, and capital allocation.
Look, you can't talk about BMNR strategy without talking about Tom Lee, the chairman. He is, without a doubt, the architect here. His background is key co-founder of Fundstrat, former chief equity strategist at JP Morgan. That pedigree lends a lot of Wall Street credibility to what is, let's be honest, a very bold, maybe even speculative play.
Right. He brings that traditional finance weight, and he's the one pushing this narrative about a supercycle for Ethereum, isn't he?
Yeah.
Driven by Wall Street adopting tokenized assets, AI needing blockchain, that kind of thing.
Exactly. He's crafting the story. And importantly, he put his money where his mouth is. He bought nearly 450,000 shares himself back in July 2025. That shows personal conviction, or at least signals it strongly.
And the rest of the C-suite kind of reflects this shift too, right? It's heavy on finance backgrounds.
Oh, completely. You've got a former JP Morgan managing director as CEO, a career portfolio manager as CFO, a seasoned lawyer heading up legal. It screams financial engineering. This isn't a tech company leadership team anymore. It's a capital markets team.
Okay, that finance focus is crucial for understanding what seems like a really weird strategy.
Yeah.
They're aggressively issuing new shares while also having a massive $1 billion share buyback program authorized. How does that make sense?
It seems contradictory, but it's actually the core of their arbitrage strategy. It's not a contradiction, it's a mechanism. Think of it as a dual mandate designed to work in different market conditions.
Okay, break that down for us.
It's actually quite clever in theory. When the stock trades at a premium to its net asset value, the actual value of the ETH and cash they hold per share, like that $70 offering they did recently when the NAV was lower,
Right.
they issue new shares at that higher price. They take the cash raised and immediately buy more Ethereum.
But wait, issuing shares, isn't that dilution? How does that help existing shareholders?
That's the clever bit. It is dilution in terms of share count, but it's accretive to the NAV per share. Imagine simple numbers. They have 10 shares, $100 in assets, so NAV is $10 per share. If they sell one new share for $15 a premium, they now have $115 in assets and 11 shares. The NAV per share is now $10.45, $115, 11 shares.
Okay.
By selling the share above the underlying value, they actually increase the value backing each existing share. Management calls this materially accretive.
Got it. So as long as the market price stays above the asset value, they can effectively print money to buy more ETH. That's bold.
Very. And the flip side is the buyback. If the stock price falls and trades at a significant discount to NAV, they can use that $1 billion authorization to buy back shares below their intrinsic value. Taking shares off the market increases the NAV per share for the remaining holders. So issue high, buy low. It's designed to arbitrage the spread between market price and asset value.
An ingenious loop, but it sounds incredibly dependent on market sentiment and their ability to keep accessing capital markets favorably.
Absolutely, which means we need to look at the actual financials, the balance sheet itself.
Chapter 3, Financial Analysis. A balance sheet in motion. Okay, first things first. Looking at traditional financial metrics here is, well, it's almost pointless, isn't it?
Completely pointless for understanding the current business.
The legacy mining operation, judged on its own, looks terrible. Net income margin is like negative 65%. Return on equity is negative 105%. It just confirms the herb business wasn't working and they're totally reliant on capital markets now.
Right, so you have to ignore things like the negative PE ratio, which is meaningless. And that price-to-book ratio, it's over 3,300 times.
3,000? I mean, doesn't that just scream bubble or overvalued? How can you justify that?
In a normal company, yes, absolutely. But here, it's an artifact of accounting rules. Standard accounting forces them to value digital assets in ways that just don't reflect current market reality, especially for assets acquired some time ago. Those metrics reflect a business model they've abandoned. They're historical noise.
So we basically have to throw out the standard accounting playbook and value it like a vault. Just look at what's inside.
Pretty much. The only intellectually honest way to assess its fundamental value right now is net asset value, or NAV. What are the assets actually worth today?
Okay.
And the balance sheet is dominated by those digital assets. The latest figures showed about $11.4 billion in total assets. The vast majority, $10.87 billion, is their Ethereum holdings. Plus, there's a notable, though unrealized, gain of about $175 million from an investment they call Moonshot in a company called 8Co Holdings.
All right, so let's do the math for everyone listening. It's pretty straightforward then. You take the total net asset value, roughly $11.4 billion. Right. And divide it by the number of shares outstanding, which was around 173.5 million.
And that gives you the intrinsic value, the NAV per share. The calculation comes out to $65.71 per share.
$65.71. Okay, that's the baseline number. That's what the stuff inside the vault is worth per share.
Exactly. Anything above that price in the market represents a premium maybe for management skill, future expectations, momentum. Anything below that $65.71 represents the discount we started with.
That sets the stage perfectly for the second half. How is the market actually treating this unique financial creature?
Yeah, let's get into that.
Chapter 4, Market Sentiment and Technical Profile.
What's really wild about BMNR is its trading volume, its liquidity. It's completely out of sync with, the size of its actual underlying operations, which are minimal now. This stock trades like a mega cap sometimes. We saw a data point showing its average daily dollar volume hitting $3.5 billion recently. That put it ahead of huge established companies like Eli Lilly.
Wow.
And earlier in the year, I think it was August, it apparently ranked as high as the 10th most liquid stock in the entire U.S. market for a period. ahead of giants like JP Morgan, Alphabet.
That can't be accidental. That level of liquidity feels strategic?
Yeah.
Like it's part of the plan?
Oh, absolutely. Management needs it to be liquid. It has to be easy for big players, traders, institutions to move large sums in and out quickly. That liquidity is essential grease for their arbitrage machine to work.
And that probably explains the insane volatility we've seen, too.
Definitely. The stock's price swings have been staggering. The 52-week range tells the story. $1.93 on the low end, up to $161 at the peak. It returned something like 459% over the past year. Its value is just completely tied to the price of ETH. It acts like a leveraged proxy for Ethereum, magnifying the moves both up and down.
So with that kind of volatility and this weird structure, I guess it's no surprise that analysts are all over the place on valuation.
Completely divergent views. It's stark. On one side, you have the consensus 12-month price target, which is around $60. That's probably driven by momentum, maybe acknowledging the premium strategy, sitting just a bit below our calculated NAV.
Okay, $60, close to NAV. But then,
if you try to apply a traditional valuation method, like a discounted cash flow model, a DCF, which values the future profits of the actual business.
right, the old mining business that's unprofitable.
Exactly. That model spits out a fair value of just 5 cents, 55 cents.
Wow, that's a massive gap. 55 cents versus $60. It perfectly highlights the split personality here, doesn't it? One number reflects the dying operational business. The other reflects the ETH vault and the market's current take on it.
Precisely. Analysts just can't agree on what framework to even use. So who actually owns this thing? That's the next piece of the puzzle.
Chapter 5. Ownership structure. A paradox of smart money and low float. Yeah, this is interesting too. The company likes to talk about its premier backers, right? Names like ARK, Founders Fund, Pantera Capital, big names in tech and crypto investing who got in via private placements. That sounds impressive.
It does. That's the smart money narrative. But then you look at this standard measure of institutional ownership, the 13F filings. Maybe we should quickly explain what those are.
Good idea.
So 13F filings are quarterly reports that big investment managers, funds with over $100 million in assets, have to file with the SEC, listing their public stock holdings. It shows you which established institutions own a stock.
And for BMNR.
It's tiny, negligible, really. Traditional 13F filing institutions own just 0.16% of the outstanding shares.
0.16%. That's almost nothing. So despite the flashy private backer names, the broad established institutional world, the big pension funds, the mutual funds, they're largely staying away.
Seems so. It suggests a real lack of broad validation for the strategy from the traditional investment community. They might see it as too risky, too complex, too reliant on ETH price.
But insiders do seem aligned, owning about 5.6%. That's a decent chunk.
Yes, insider ownership is relatively high, which is generally seen as a positive alignment of interests. However, there's a catch for potential future shareholders.
Dilution risk from warrants.
Ah, the warrants. Explain those. There's a significant overhang. About 10.4 million potential new shares could be created if warrants are exercised. These warrants have an exercise price of $87.50 per share.
$87.50. So if the stock price goes above that?
Exactly. If ETH rallies enough to push BMNR's stock price above $87.50, holders of those warrants can buy new shares at that price. It creates a kind of psychological ceiling near that level. And more importantly, it guarantees future dilution if the stock performs too well, which can cap upside for existing shareholders.
Okay, so complex ownership, potential dilution. It all feeds into the risk assessment. Let's tackle that directly.
We have to. The potential rewards are clear, but the risks are just as stark.
Chapter 6, risk assessment. Navigating a minefield.
Look, the biggest risk, bar none, is asset concentration. This isn't a diversified company. It's effectively a single, massive, leveraged bet on the price of Ethereum, period. If ETH crashes, BMNR's NAV crashes directly and proportionally. A 50% drop in ETH means roughly a 50% drop in their core asset value. There's no cushion from other operations.
And that ties into the execution risk too, right? Their whole arbitrage strategy, the issuing shares high, buying low. It only works if they can access capital markets smoothly.
Absolutely critical. If market sentiment turns negative, if their stock starts trading at a persistent, deep discount to NAV, that funding mechanism breaks down. They can't issue shares accretively anymore. They'd have to rely solely on the buyback, which eats cash. If the discount gets bad enough and they can't raise funds, you could see a negative feedback loop. Some analysts call it a potential death spiral risk.
That sounds pretty grim.
It's a real tail risk. And then there's the regulatory environment, specifically competition.
You mean the potential for spot Ethereum ETFs in the U.S.?
Exactly. If, or perhaps when, those get approved, they introduce a direct, regulated, and probably lower-cost way for investors to get ETH exposure.
So why is that such a direct threat to BMNR?
Because right now, a big part of BMNR's appeal, especially to institutions, is its status as a liquid, publicly traded proxy for ETH. It fills a gap. An ETF offers that same exposure, maybe even better because it's simpler, regulated directly as an investment product, likely has lower fees, and doesn't have BMNR's company-specific risks, the management risk, the arbitrage complexity, the dilution overhang.
So an ETF could suck away demand and liquidity from BMNR, eroding that premium or even deepening the discount it might trade at.
Precisely. It could significantly undermine their core value proposition as the primary institutional gateway to ETH.
Okay, we've covered the business, the management, the finances, the market, the risks. Let's bring it all together. Time for the verdict. Chapter 7. Conclusion. The value investor's verdict.
So, synthesizing all this, BMNR isn't really a tech company anymore, is it? It's morphed into this hybrid creature. It's part leveraged liquid proxy for Ethereum, letting you trade ETH indirectly, and it's part complex capital markets arbitrage machine, trying to play the spread between its stock price and its assets. Its whole identity is tied to that balance sheet. And revisiting the numbers one last time. Market price around $56.59, intrinsic NAV calculated at $65.71. That confirms the discount 13.9%. So mathematically, yes, the analysis shows you are buying the underlying assets for about 86 cents on the dollar. The arbitrage opportunity is quantifiable and real based on current prices.
Okay, so what's the final call for you, the listener, especially if you approach things from a value investing perspective? The discount is there, it's clear. But here's the crucial takeaway. A drop of just 14% in the price of Ethereum, which, let's be honest, can happen quickly in crypto, would wipe out that entire margin of safety. Doof, gone.
Right.
Given that extreme volatility of the core asset, the company's total dependence on favorable capital markets, the ongoing risk of dilution from warrants and future share issuance, and that looming threat of ETF competition. Our conclusion is that BMNR, despite the current discount, is fundamentally unsuitable for a traditional conservative value investor seeking a reliable margin of safety.
The risk profile just pushes it firmly into the realm of speculation, not fundamental investment. The potential reward doesn't adequately compensate for the multitude of significant risks.
It's a fascinating machine, but maybe too fragile for a value portfolio.
And maybe a final thought for you to consider. Management has been pretty successful so far, navigating this arbitrage between their stock price and NAV. What would it actually take for this whole system to break? Is this Alchemy of 5% strategy really about the long-term goal of holding 5% of ETH? Or is it more fundamentally about just keeping investor confidence high enough to sustain the arbitrage loop itself to keep the machine running? Something to mull over.
We really hope this deep dive into BMNR's radical transformation and its unique valuation has given you a useful shortcut to understanding this very unconventional stock. And hey, if you want more deep dives like this, especially as we cover all 500 stocks in the S&P 500 over the next few months, please like and subscribe to Stock Analytics AI. Members get priority access to these deep dives for just €4.99 a month. Or, if there's a specific stock you want us to analyze, you can drop us a super thanks for a one-off deep dive.
And just the standard reminder, this analysis was generated using an AI research protocol. It's based purely on the source materials we fed it and is intended only for educational purposes. We aren't providing investment advice. Thanks for tuning in.